there is new legislation on the table that could completely change the landscape of the housing market. This is across the country, but it could impact Phoenix specifically. If you're a seller, this is not good news for you. But if you're a buyer and you've been waiting in the wings to find more options for housing and more affordability, this could be your chance. Democrats introduced bills to ban hedge funds from single-family housing markets. Now, there's a couple bills. One is called End Hedge Fund Control of American Homes Act of 2023, and another one, American Neighborhoods Protection Act. It requires corporate owners of more than 75 single-family homes to pay an annual fee of $10,000 per home into a housing trust fund to be used as down payment assistance for families. It also forces them to sell off their portfolio and would ban these hedge funds from owning any single-family homes in the future. So how will this impact the market? Well, let's rewind the clocks and remember how we got here. We know inventory has been low for some time now, and this all really started after the great financial crisis. Builders got very gun-shy after having a heck of a time and stopped building as many homes. Meanwhile, our population continued to grow. You can see here in 2009, 10, 11, 12, the number of homes being built and permits being pulled from builders was minimal compared to what we were doing in the past. And it's taken us a very long time to start to gain some momentum and start building again. So with low building activity and our population continuing to grow, this put us into a seller's market. Starting around 2014, we had more demand than we had supply for quite a while. And although it was a weak seller's market, we were seeing price increases year over year. All of this was fairly normal until we hit 2020. The pandemic accelerated the housing market across the nation, but we saw a lot of this in Phoenix and other cities like Austin and Boise as well. Our inventory remained low, but demand grew well beyond normal. At some points, we were maxing out our demand close to 35% above normal. Now, this demand wasn't only fueled by the typical home buyer, it was fueled by Wall Street as well. Large corporate investors like Blackstone and Invitation Homes started purchasing a lot of homes in the Phoenix area to turn into rentals. Now, with the typical supply and demand equation, you know how this goes. With much higher demand than we had supply, we were in a seller's market where we started to see price increases like we've never seen before. We went from a median home price in January of 2020 of $289,900 to where we stand today at the end of 2023 at $439,000. That's an increase of about 51% in the last 3 years. The housing market across the US got out of control, and so did inflation. So the Fed stepped in 2022 and started hiking the federal funds rate. They've been on a mission to lower inflation since then and have been seeing a lot of good progress, but everything that they've been doing has also increased the mortgage rates. With mortgage rates getting so high and prices not coming down, this really tampered our demand, but it also created another problem, the lock-in effect. Mortgage rates went from a low of about 3.9% in March of 2022, all the way peaking at about 8% a few months ago, and now we're back down to about 7.09%. With the lock-in effect, people don't want to sell their home and give up a 3% interest rate if their only option is to pay a higher home price and a much higher interest rate, making their monthly payment so much higher. So even though prices and inflation have come down, we still have a supply issue. Not only do new buyers not want to purchase, but home sellers don't want to sell because they don't like the alternative. Having low inventory and still some steady demand has kept our prices high. Through all of this, builders still are not building enough homes for the amount of people that we have in the Phoenix area. You can see how this has tapered off in 2022 when builders got spooked once again when rates shot up and demand went down, and this year we haven't truly recovered from that either. So the question is, how do we get enough homes out there for the buyers that are willing and interested to buy, and how do we ensure that these homes are affordable? Well, if you get enough homes out there for the number of people that want to buy, we will eventually have more of a balance between supply and demand, and prices will adjust accordingly. So much of this really comes down to a supply issue, and that is where this new legislation comes in. This bill aims not only to ban hedge funds from amassing large portfolios of single-family homes, but also to force them to sell off their portfolio. The bill would require hedge funds to sell at least 10% of the number number of single family homes they currently own to families per year over a 10-year period. And after the 10-year full phase out, all hedge funds would be completely banned from owning any single family homes. So that's great that it will open up inventory, but how much are we really talking about here? Well, just by doing a quick search on Google, research by MetLife Investment Management suggests that as of August of 2022, institutions owned approximately 700,000 single-family rental homes. Now, that's been a while since August of 2022, but let's just use this number to kind of get an idea of how many they own and how many they'd be selling off. How many housing units are in the US in total? Well, according to this, about 143 million housing units. So 700,000 units is less than 1% of the 143 million housing units in the entire United States. So will this even make an impact? Well, it depends where, because some areas might be more susceptible than others, and I think Phoenix may be one of those. The investor share in Phoenix is somewhere between 15 to 20%, and I'm gathering that just knowing what these purchases have been like over the last few years and the intended use. The pink is the investor purchases, and they've consistently bought somewhere between 14 or 15% and at a peak of about 21%, and then they've kind of come back down. So knowing that they own these homes and assuming they have not sold them off, I'm going to say that we have about a range of 15 to 20% investor ownership here in the Phoenix area. So how many housing units in total do we have in the Phoenix metro area? According to Google, as of July 2022, again, some older data, we have about 1.87 million housing units in the Phoenix area. 20% of that number is about 375,000 units. That's a lot of inventory. If all of that came on the market, that would make a huge impact, but as the legislation said, this would be done over 10 years. So for simplicity's sake, let's just divide 375,000 by 10, which means we've got about 37,500 homes every year that these investors would have to sell off in Phoenix. How does this compare to the number of sales we see in Phoenix every year? Well, if we go back to the years before the pandemic, we were at about 96,000. So let's call it 100,000 sales per year. 37,000 added sales each year would be an increase of almost 40%. And I'm not confident we have 40% more demand looking to buy. So if this passes and they do sell at that rate, assuming all of these numbers are correct, this could have a significant impact in the Phoenix market. Now, they're saying the likelihood of this passing is low, but I want to hear from you. What are your thoughts on this legislation? Do you think it's a good idea? And would it really impact the Phoenix market? Put it in the comments below and make sure you hit that like button and share this video if it's helpful. So where do we stand today with supply and demand? Well, we're going to take a look at the Cromford Market Index as we do every week. We are sitting in balance. Any number between 90 to 110 is considered a balanced market. Our demand is still pretty low, 32% below normal, and our supply is sitting 35% below normal. So sitting in balance because supply and demand are fairly close to one another, but both are below normal. Therefore, we have a pretty slow market right now. Looking at every city, you'll see something a little bit different here. We have Chandler coming back on the chart with a green arrow. Goodyear is green again. So what this means is buyers lost a little bit of ground in Chandler and in Goodyear, and sellers gained a little bit of an advantage. Pretty small, especially for Chandler, but we are seeing some movement in that direction. This past week, there was an average decline of 9.9% month over month in all of these cities. And last week, I talked about this, it was 13.1%. So we saw a slower decline this week than we did last week. We're seeing gradual improvement in the demand trend, and supply is no longer increasing in most areas. Why are we starting to see some of these changes? Well, it is the end of the year, which is a slower time, but also mortgage rates have been moving in a very favorable direction for buyers over the last month or so. Last week, we got the jobs report, and that information didn't change mortgage rates all that much. I'm recording this on Monday, but on Tuesday, we'll get the CPI information, and the Fed meets for their final time this year. So stay in touch with your lender because things could change with mortgage rates this week depending on how that information comes out. Check the description below for resources if you're a buyer or a seller, and don't forget to watch this video here to learn more about market predictions for 2024.